Recently, I have been asked this question: should we ditch property? And it is connected to a much broader question, which requires us to address the answer of why do investments rise in value generally? And I think this is a really important conversation to have right now, especially after we've just endured 4 years of a very difficult property market. So, my name is Darcy Ungaro. I'm a financial advisor. I'm a podcast host. If you're new or you're returning, thank you for joining me on this one. Please be sure to subscribe to this channel and like this show in particular if you want the YouTube algorithm to recommend more videos just like it to help you on your journey. Let's get started. Now, in my own financial advice practice, I talk with people of every background and I help people to align their own personal finances to where the world is going. And I don't have any skin in the game when it comes to your own finances. I'm not trying to sell anything here, but I have done a few things when it comes to investing in property and other asset classes. And I've noticed that over time, there are a few things that people bring up over and over again. Like when a particular market is suffering after a few years, there's always those that will question, is now the time to get out? Never question it when the property market's going great, but when it hasn't been going great, it's natural to think like this. I'm old enough to remember, though, when property was just a home and it wasn't an asset. It was a shelter and it was a container for families. It only takes one generation for things to change, though, and it's true. Now, property is an asset, it's an asset class, and it's what's built a lot of wealth for a lot of Australian and New Zealand and Canadian and American and British families. Property investment is the drug of choice. It's fairly simple because the banks are willing to provide the credit. That's the lending, that's the leverage. Tenants are willing to live in the property and pay rent. That's the cash flow that you need. And in some jurisdictions, like New Zealand, you might even be able to obtain tax-free capital gains when it's time to sell it. Now, I should acknowledge that half of you listening probably believe that property investing is bad. I'm not going to judge you for that at all because I can definitely understand that side of the equation. The other side, though, will look at property as the way and perhaps the only way to be successful as an investor. There's more than one way to get things done, though, thankfully, and it isn't, in fact, about the tools or the lack of tools. It's about what you're trying to build. That's what's important. But with all types of investing, there are often negative spillover effects. There's bad things that can happen in the pursuit of financial gain. Like, think about your tech shares that you're investing in. Do you really want Google, Amazon, Microsoft, Nvidia? Do you really want these companies being so large that they literally dominate the world? Well, no, of course not. But do you want ever increasing gains from your investments over time? Yes. Though those two things are kind of at odds when you look behind the scenes as to how things actually work. But I don't want to take sides in the debate, of course, but the perspective of most property investors is that they believe that they are providing a long-term accommodation service to those who cannot afford to own their own home themselves. And for full disclosure, I am a property investor as well. But rather than place the burden on the state, property investors believe that they should do something about it and they're willing to put their capital on the line. And they do it all because they believe that over time, prices will rise for property, which means they can sell it and receive a financial gain. Of course, the other strategy is to own an investment property and repay the mortgage to create passive income. Again, a lot of ways to do that. That's not what this video is about. It's about whether or not, I guess, the property investment market is broken or not. Now, unfortunately, for property investors, the last 4 years have been very average. Adjusted for inflation, it's been terrible. But property investment is starting to come back early stages. And we know this because it's becoming much easier to obtain funding from the banks again. Much easier in that it's cheaper now to borrow than what it was even just 6 months ago. So perhaps before we address the question of whether or not the good old days of property investment are over, allow me to explain two mainstream reasons why property investment works, especially in New Zealand, and one reason why all investment types work that no one really talks about. And it's that last reason that I want you to pay attention to because If you decide that property investment isn't for you, or you're an existing investor and you think, no, it's time to ditch it, then the more you understand this third reason, the better choice I believe you will make if you decide to get out. So, the number one reason why property investment works: number one, immigration. In New Zealand, like many Western countries, we've adopted an economic, I guess it's an economic strategy, rightly or wrongly, of bringing in more people from overseas to live here rather than encouraging the growth of our own population. So, more and more people equal more and more demand for housing. And after factoring in restraints to bring new supply of housing to the market, prices will naturally adjust upwards if there's an imbalance going on there, which there often is. Number two, income growth. As wages naturally rise over time, there's an increase in borrowing power possible because banks will look at how much you make to determine how much to lend to you. With more and more people able to spend more money on property, it naturally bids prices upwards. So, immigration, income growth, and lastly, inflation. As the price for building a new home increases over time, along with all the compliance costs and all the extra taxes and the regulation and red tape, people find that existing housing actually looks relatively quite cheap. And so all forms of housing and accommodation rise over time because of this inflation. So inflation is a massive driver behind growing house prices. But there's a very dirty secret here that requires just a little bit more thinking than what most of us are willing to engage with. Property rises over time because the money supply is inflating. It's not the prices of goods and services that we need to think about, it's the quantity of money that's being inflated. And the truth of the matter is that the supply of money has to always increase over time. What we're taught in school and even in universities is something called the intermediation theory of banking. This is where banks will take the savings from one group of people and they will lend it out to borrowers on the other side of the equation, and they'll take a margin in between. Another way to explain how the banking system works, though, is the credit creation theory of money. In short, every time government, businesses, and everyday people like you and me go to the bank to get credit, we are effectively causing the bank to create money out of thin air. Didn't exist before, but now it does. And yes, we have taxes to pay. Yes, we're repaying debt often when we take out this new credit. But on balance, the money supply grows over time. In fact, the US data suggests that since 1971, the growth in something called the M2 money supply, which effectively is cash or investment instruments that can be converted to cash really easily, it's grown by approximately 7.4% over 50 years. New Zealand will be no different. So the combined borrowing and lending activity of banks to government, to corporations, and to individuals like you and me will inflate the supply of currency at work in the economy over time. And an increasing supply of money in the hands of people to buy stuff in an economy which can't produce stuff fast enough will naturally rise prices. And here's where I'll introduce a new term, maybe for some of you, called the Cantillon effect. So those closest to the supply of money, those closest to the money printer, are those closest to new wealth. All property investors are even doing is leveraging off of this practice. Many of them have no idea that's how it all works. So it's because of this dirty little secret, though, that you can own a duplex and watch it double every decade. New Zealand is a housing market with an economy bolted on the side of it, and that economy is propped up through new currency creation from the banking system. Income growth will hit a limit. Immigration will hit a limit. Well, it should hit a limit at some stage. And inflation, will that hit a limit? I don't think so. The financial system that we operate in is only ever stable when the expansion of debt is occurring. But the side effect of this is that everything that can be denominated through these dollars, which lose value every time new dollars are created, means that it looks like it's increasing in value. Assets and property is just one of those assets, are the sponges that soak up the new credit creation that occurs over time. Anything finite, like property, like gold, like silver, and like digital finite assets, they will all rise in price relative to infinitely produced money. And this is pretty much what I would say if you came to me as your financial advisor and you asked me, hey, should I sell my investment property? I'm worried that over the next 10 years, it won't be rising in value like it always has. Well, I'd probably say to you that, in my opinion, and based on what I understand with how the system works, property will continue to work as a wealth strategy so long as our financial system operates the way that it does, where there is ever expanding amounts of new credit moving into it. So if you're thinking of exiting property, or if you're trying to decide whether property is for you or not, well, we can now address that question a little bit more accurately, because if not this, then what, right? If you're not going to hold investment properties, and if you're going to ditch your investment properties, where are you going to put that money? You certainly aren't going to put it in the bank account and just leave it there, watching the value of it erode over time due to inflation. You want to put it into other investments, which will hopefully grow at a rate faster than the rate at which your currency is being watered down by. Now, one of the options, which is scarce, that people are increasingly talking to me about, which I'm not advising you to buy, but I am advising you to learn more about, is Bitcoin. It's the ultimate digital form of scarcity. Property is scarce assets. Gold and silver, those are scarce assets. And so is Bitcoin. It's digital scarcity. There can only ever be 21 million of them. No one can print them out of thin air, which is ironic because it was literally created out of thin air in the digital realm. But because it has the largest network of adoption, it's most likely going to be the form of digital asset that becomes valuable in the future. In fact, I'd go so far as to say the reason why property investment works, the reason why a diversified portfolio of tech stocks will work, the reason why managed funds will work is the exact same reason that Bitcoin will work as well. It's the exact same trade. So, on one hand, with property, you can stick with the dodgy tenants who occasionally miss rent. You might want to prefer dealing with the stained carpets or the raw chicken breast that they leave in the microwave, or the rising interest rates that you have to deal with and the rising property taxes. Sounds like a little bit of a headache, so I can totally understand why people would be having second thoughts. But if not that, what else would give you the type of performance that property gives you, where you can put a little bit of money in and a bank will give you a lot more money, and a tenant will help pay the interest costs, and the government will allow you to have those gains tax free? There's not actually a lot of options that will give you that performance. So you have to look at being the first on the next form of scarcity that you can buy with the money that you have now. Now, of course, I am just putting it out there. You can do what you want with it. It's certainly not personalized financial advice because I don't know your circumstances, but I will leave you with this one thought before we finish up. To invest well, I think we should balance the realities of how the world actually works out there with the constraints of our own personal finance. I can't say whether or not you should dump your own properties, but I will suggest that the way the world works, although it's not pretty, isn't likely going to change anytime soon. So stay safe out there. And if you would like to chat, just check out that link in the notes to schedule in a free 15-minute conversation. Catch you in the next one.